Okay, we are recording. Hello there, everybody. I am doing this recorded lecture to go over the Chapter 8 PowerPoints. In Chapter 8, we are looking at inventories and how we can value the ending inventory and cost of goods sold related to inventory. So we get into um, FIFO, LIFO, and the weighted average or the average cost method, which for those of you in cost and managerial accounting right now, we just a couple weeks ago talked about FIFO, LIFO, and the weighted average method in there. So some of this should look familiar to you, and of course we're going to get practice with it in class together. So let me share my screen with you, and we're going over the Chapter 8 PowerPoints. And actually, as we will see as we continue through our textbook, we also talk about inventories in Chapter 9 as well. But we're starting with Chapter 8. And as we can see here from the learning objectives, we're going to look at different inventory classifications and inventory systems, calculating or determining the goods and cost included in inventory. This is where we have the FIFO, LIFO average cost method, those cost flow assumptions to, using those for inventories. And then looking at some special issues related to LIFO, and then when there are inventory errors. So kind of the bulk of this is really learning objectives 1, 2, and 3. But anyway, we'll look at these together and of course get practice with them in class. So inventory classifications, inventories in general are considered assets, current assets to be more specific, right? And depending on whether the company is a merchandiser or manufacturer, inventory accounts can look a little bit different. And so just like it shows here, again, our inventories, items held for sale in the ordinary course of business, or goods to be used in the production of goods to be sold. So in the former, items held for sale in the ordinary course of business, this is a merchandiser, right? So merchandiser buys goods and products and then resells them, hopefully for a profit, right? So they buy them from, directly from the manufacturer, from a distributor, and then they resell them to the consumer, right? That's a merchandising company like a Walmart, a Target, a Walgreens, any of those organizations that, again, they buy goods or products directly from the manufacturer or from the distributor, and then they sell those goods or products to the final consumer, you or I, right? The customer. Um, and so they usually have just one main inventory account, as we'll see, merchandise inventory. Whereas again, the latter, goods to be used in the purchase of production, in the production of goods to be sold, a manufacturer usually has the 3 inventory accounts. Raw materials inventory, work in process inventory, finished goods inventory. So again, we'll see examples, and we have already talked about the inventories in these 2 types of companies before, but especially we've been focusing on this in cost and managerial accounting as well. Okay, so this example is showing us the example of a merchandising company and how their inventories may look on the balance sheet. Again, they have the one main inventory account, merchandise inventory. Every time we purchase more inventory, we debit inventory, credit accounts payable, or credit cash, whatever, right? We debit merchandise inventory, credit accounts payable. And then when we sell inventory, then we are reducing merchandise inventory, right? So then when we sell inventory, we are debiting cost of goods sold, crediting merchandise inventory. And then also we have to record the sale, which is like the debit to cash, credit to revenue, or debit to accounts receivable, credit revenue, whatever. So they just have that one main inventory account. And again, that one main inventory account is impacted every time we purchase inventory, every time we sell inventory, right? Whereas a manufacturing company, like they're showing us the example here, manufacturing company has 3 inventory accounts: raw materials, work in process, finished goods. Again, for those of you in cost and managerial accounting, we've been discussing these accounts. We've been getting practice calculating these different costs and things like that in cost and managerial accounting as well. But these inventory accounts are still considered assets, right? Current assets. So you see them here on the balance sheet. And in this case, they have work in process and raw materials together in this one. So we could see it that way, or we could see, all 3 of them individually, type of thing like they're showing us here. So it's really up to the company, how they want to present that, but this gives you an example of that. All right, so inventory cost flows. So, we're going to be getting practice calculating each of these elements, or each of these areas. So beginning inventory plus cost of goods purchase equals cost of goods available for sale. And then the cost of goods available for sale should be able to be allocated between the cost of goods sold and then the cost of ending inventory. So, just to make the math easy on me, and again, we're going to get practice with this, but just to make the math easy on me, if we have cost of goods available for sale of 5,000, okay, cost of goods available for sale 5,000, and then we should be able to divide up or allocate that 5,000 between what we sold and what we have left. So if we have cost of goods available for sale of 5,000 and cost of goods sold was 4,000, then that should mean ending inventory is 1,000, right? So we can allocate that cost of goods available for sale between cost of goods sold and ending inventory. So just like your book talks about, the 2 main types of inventory systems are the perpetual system and the periodic system. The perpetual system is the inventory system that is really being perpetually updated, if you will. So updated after every purchase and every sale. And this is what we talked about with a merchandising company. So every time we purchase inventory from a distributor, we purchase inventory from a manufacturer, we're debiting merchandise inventory. And then every time the customer goes to the cash register and rings out their sale, then that sale is crediting merchandise inventory. So it's reducing merchandise inventory for what was just purchased by that customer, right? So it's perpetually being updated after every sale. A periodic system, on the other hand, is updated periodically. So if we close our books every month, we might just do counts at the end of the month and update it on a monthly period basis. If we close our books on a quarterly basis, then we might update the inventory amounts and inventory accounts every 3 months would be the periodic time frame. So periodic system inventory is updated periodically. So every so often, right? Every month or every quarter or once a year, I guess maybe for a smaller organization. So and we'll look at the differences between the 2, and then I have exercises picked out for us where we get practice calculating it both ways. Okay, so just like we talked about a little bit on the previous slide, perpetual system, the purchases of merchandise are debited to inventory. Freight in is debited to inventory. So this is the freight cost associated with the purchase Purchase returns and allowances and purchase discounts are credited to inventory. So those reduce our inventory costs. And cost of goods sold is debited to inventory. Cost of goods sold is debited, and inventory is credited for each sale. And then subsidiary records show quantity and cost of each type of inventory on hand. Again, perpetual inventory system being perpetually updated after every purchase and every sale. So the perpetual inventory system provides a perpetual, right? A continuous record of inventory and cost of goods sold. The periodic system, again, purchases of merchandise are debited to purchases. We're only updating inventory periodically. Ending inventory determined by a physical count. And then calculation of cost of goods sold. We take beginning inventory plus purchases. That gives us cost of goods available for sale. And we take cost of goods available for sale minus ending inventory gives us cost of goods sold. And we basically do this calculation every time we calculate FIFO, LIFO, or the weighted average method. So we'll get practice doing this together several times. All right, so comparing these two systems. So based on this information, okay, we had beginning inventory, 100 units at $6 each. That would be $600. We had purchases of 900 units at $6 each. That would have been a total cost of $5,400. We sold then, so we had 1,000 units. We had beginning inventory of 100. We purchased 900. So then we had 1,000 units available for sale. And then we have sales of 600 units at $12 each. Okay. And then ending inventory. So we had 1,000, 100 units at $6 each, 900 units at $6 each. So we had 1,000 units. We sold 600. We've got 400 left, right? Ending inventory, 400 units at $6 each, right? Record these transactions using the perpetual and periodic inventory systems. So the both systems, beginning inventory, 100 units at $6 each. So then in our inventory account, we would have had a debit balance of $600 on both sides of these, right? The difference comes in with the way that they're recorded and the name of the accounts, right? Because we use purchases under the periodic inventory system. So under the perpetual inventory system, we purchased 900 units at $6 each. So 900 times $6, $5,400, debiting inventory, crediting accounts payable, right? And then we sell 600 units at $12 each. So every sale, again, there's two journal entries that go with the sale. The journal entry to record the sale, and that's the first one that you see. And then the journal entry to record the movement of that inventory, those costs from inventory to cost of goods sold. So since we're selling it, it's moving it out of inventory into cost of goods sold. So we're debiting cost of goods sold, crediting inventory. And then the end of period entries for inventory counts. Again, this inventory account under the perpetual inventory system is continually being updated. So there is no end of period adjusting entry, right? It would show we had 600 or $600 to start. We purchased another 5,400. That means we had 6,000 worth of inventory available. And then we sold 3,600 worth. So 6,000 minus 3,600, we've got 2,400 balance in there is what it would show. Okay, perpetual inventory, periodic inventory system, on the other hand, the inventory account, again, beginning with $600 would be the debit balance in the inventory account. We purchased 900 units at $6 each. So we're debiting purchases, crediting accounts payable. And then we sell 600 units at $12 each. Again, that entry to record the sale is exactly the same, right? We're debiting accounts receivable, crediting sales revenue, but we're not recognizing the cost of goods sold and the ending balance in inventory until the end of the period adjustment. So then at the end of the period, we're debiting inventory for the amount of inventory we have left over, right? Our ending inventory. We're debiting cost of goods sold for the amount of inventory that was sold, the cost of goods sold, right? The cost of that inventory. Crediting purchases and then crediting beginning inventory. Okay. Anyway, I have a couple exercises picked out where we get practice with these journal entries together. So, all right, inventory issues, a couple things that companies have to think about when determining physical inventory at the end of the year is, at least once a year, a company does want to take physical inventory counts. And so, we want to compare what we have on the shelves or what we have in our stock room or our storage room. We want to compare what we have physical inventory to what it says we have in our accounting system, right? We have to make adjustments because generally speaking, those two things do not equal, especially for a larger company that has a lots of ins and outs through the year. Usually those do not equal, right? So companies, have to take a periodic count or physical inventory account, by actual count, by weight or by measurement, depending on, again, the product or the good. And then we want to compare those counts to our inventory records, to what our computer system says that we should have, right? So, you know, um, I remember this when I was a teenager, I worked at an old company called Venture, and I know probably none of you remember Venture. Venture was bought out by Kmart, and now Kmart doesn't even exist anymore. So most of you might not remember this, but I remember at Venture they used to do this before they closed their books for the year, and so it was always, and they were on a fiscal year. Their year ended, if I'm remembering correctly, January 31st. So they were on a fiscal year of, February 1st is when their year started through January 31st. And so it was always like a big deal. People worked long hours, 12 plus hour shifts, and it was like 2 days straight. That's kind of all hands on deck. Everybody was counting, and you had the clipboards and the tallies. And, nowadays I had a student, I guess 3 or 4 years ago now, that said that he worked at Best Buy. And at Best Buy, when they take physical inventory, they have a glove that they put on, and the glove has sensors in the fingertips. And so when you're counting something on the shelf, instead of taking, with paper and pencil, the tallies on a clipboard, you're wearing this glove that has sensors in the fingertips, and then all they have to do is just touch the unit, touch each, whatever DVD player that's on the shelf, or touch each, product on the shelf, and it automatically keeps count for them. But, nonetheless, companies do have to take physical inventory, and then we have to make adjustments, based on, what we actually have versus what it shows on our shelves, right? Or what it shows in our computer system, rather. All right, so determining cost of goods sold. We can determine cost of goods sold, based on these cost flow assumptions, and that's, the FIFO, LIFO, the weighted average method. And so what we're going to see when we start these calculations is that, basically we're dividing up cost of goods available for sale, and we're allocating that, or we're dividing that up between ending inventory and cost of goods sold, right? So that's what it's showing us here. For example, if we had cost of goods available for sale of $900, And then we do a count at the end of the period or whatever. We've got 200,000, excuse me, cost of goods available for sale of 900,000. And then we do a count at the end of the period. We've got ending inventory of 200,000. Well, then that means we must have sold 700,000 worth of goods, right? So again, this is really what we're calculating when we're using FIFO, LIFO, the weighted average method for inventory. We're calculating ending inventory and then cost of goods sold. All right, so goods included in inventory, a couple things that, we have to keep in mind are like goods in transit, goods on consignment, goods that are damaged or obsolete. So there's a few issues in dealing with goods that we include in our inventory. And so it shows here a company recognizes inventory and accounts payable at the time it controls the asset. So, depending on our shipping terms, for example, and I think this is shown on the next slide, whether what our goods in transit, whether they were shipped FOB shipping point or FOB destination, who paid for the shipping costs. So if the buyer pays for the shipping cost, FOB shipping point, then the buyer has legal title to the goods, has control of the asset, right? In the case of FOB destination, when the seller pays the shipping cost, then the seller has legal title to the goods, right? And so usually this, who controls the goods or who, legally owns the goods is kind of the issue as to whether or not it would be included in the inventory, right? So we look at that on the next slide. Another thing that it's going to talk about, goods on consignment. Most of you probably have heard of a consignment shop. Basically, you could think of eBay like an online consignment shop where the goods do not necessarily belong to eBay, right? The goods belong to individual sellers that are selling their goods on eBay. So, a local consignment shop has goods in their consignment shop that do not belong to them necessarily, but belong to the consignee. And so that person who owns the consignment shop would not include those goods in their inventory, right? Because those goods belong to someone else. They're just essentially selling them for that person type thing, right? So goods on consignment have to be taken into account. And then the other thing is like damaged goods or goods that become obsolete and that are not able to be sold. And again, this requires an adjusting entry, usually for impairment of the inventory. We talk about impairment more. That's funny. I'm looking at the book so I could tell you. Where is it? Oh, and of course now I can't find it. Chapter 11. We talk about impairment more in chapter 11, but that's what happens when we have goods that become obsolete. So anyway. Okay, so FOB shipping point versus FOB destination. Again, if we're trying to think of whose inventory would we include these goods in, right? So FOB shipping point, the buyer pays the freight cost. So the buyer is in control of the inventory once it leaves the seller's location, right? Buyer pays the shipping cost, so buyer has the control. So that's when ownership passes, when the goods are, the goods leave the sellers, right? FOB destination, on the other hand, the seller pays the shipping cost. So ownership doesn't transfer to the buyer until the goods are delivered. So we'll have to keep that in mind. And I have an exercise picked out. I want to say it's like brief exercise 8-2 or 8-3 or one of them, but I have an exercise picked out where we get some practice with this. We just have to remember FOB shipping point. The buyer pays the cost, so the buyer is in control and it's considered part of the buyer's inventory once it's picked up from the seller. FOB destination, the seller pays the shipping cost, so it's not included in the buyer's inventory until it's delivered. The seller maintains control of it until it's delivered. All right. Consigned goods, again, I mentioned this a moment ago. The consignment shop owner, does not consider the consigned goods part of their inventory, right? The person who owns the goods and is selling them in the consignment shop, those individuals have control or own the goods, so it would be included in their inventory, not the consignment shop owners, right? All right, sales with special agreements, just like it shows here, this usually involves a transfer or a sale with either an implicit or explicit repurchase agreement. So just like it shows here, these are kind of referred to as parking transactions where, I'll buy them, but then, we have some type of provision in the contract that says, they're going to be repurchased at this time, for example. And so, just like it shows down here, we wouldn't record the revenue at the time the inventory is parked, right? It's when the control is transferred to the buyer, the performance obligation or the goods or the products, right? When the control is transferred to the buyer. With these special sales agreements, when there are high rates of return, we record said sales revenue at the amount it expects to receive from the transaction. And then we establish basically a contra asset account, estimated inventory return account. You could think of it kind of as like, sales returns and allowances almost, or allowance for sales returns and allowances, right? An estimated inventory return account for some portion or some percentage of the inventory that will be returned. And so, yeah, contra asset account, it would reduce inventory balance. All right. And then we've also touched on this before, I know definitely in cost and managerial accounting, but product cost versus period cost. Product cost are the costs directly connected with bringing the goods to the buyer's place of business and converting such goods to a saleable condition, right? So if it's a merchandising company like a Walmart or Target or something, their cost of goods sold or their products are product cost, right, are the cost of goods that they purchased from the distributor or from the manufacturer, plus any freight cost, less any purchase discounts or purchase returns or allowances, right? Whereas the product cost for a manufacturer include the materials, the labor, the overhead, right? Because they're converting raw materials to a finished good. So product costs are different, whether it's, manufacturer or merchandiser, right? Hopefully we understand the difference, right? Merchandiser, they purchase goods and then resell them. So those are their product costs, right? The cost of goods purchased, plus any freight cost, less any purchase discounts or purchase returns or allowances. Whereas product costs for manufacturer, direct materials, direct labor, factory overhead, right? And then period cost are the costs, selling, general, and administrative expenses not associated with the product. Okay. And then just like we talked about in the previous chapter, those purchase discounts are either handled with the gross method, which is what we've gotten a good amount of practice with before, and then the net method, right? So a couple things that we think about here with inventory. All right, so then the cost flow assumptions, which cost flow assumption? So the cost flow assumptions are the FIFO, the LIFO, the average cost method. Specific identification is where when we sell goods or products, they can be specifically identified with a single unit. Excuse me. Right? So, just like your book tells us, when we sell a car, for example, it can be specifically identified to, a particular vehicle, right? Or if we sell jewelry or, something that is not necessarily a mass produced situation where we have, thousands of units being produced or whatever, right? Specific identification, we can relate the sale or we can, record the sale based on a specific unit in the inventory, right? In most situations, though, a cost flow assumption works better. So we use FIFO, LIFO, the average cost method, and looking at these cost flow assumptions, FIFO is used most often. There are some issues with LIFO that this chapter talks about. And then as we're going to see when we're doing these calculations, oftentimes average cost kind of falls in the middle of FIFO and LIFO. And so, again, we'll see that when we start doing some of these calculations together. All right, so looking at this data, then we're going to walk through some of these examples. So it says CalMart, and let me just see how many times I've got to click here. CalMart Inc. had the following transactions in its first month of operations. Okay, so March 2nd, 2,000 units at $4 each. So 2,000 units times $4 each, that would have cost us $8,000, right? We had 2,000 units at that point. March 15th, 6,000 units we purchased 6,000 units at $4.40 each. So just like it's showing us down here, 6,000 units times $4.40 each, that would be 26,400. So our cost at that point, we had 8,000 to begin with, plus 26,400, right? That would have been our cost so far. And then we had 2,000 units. We purchased 6,000. So now we're up to 8,000 up to 8,000 units, right, is our balance. And then we sold 4,000 units here. So then once we sold 4,000 units, we only had, because we had 8, we sold 4. Now we've got 4 left. Okay. And then we purchased 2,000 units at $4.75. So now we're up to, we had 4,000, we purchased another 2. Now we're up to 6,000 units. And so we had this beginning inventory, 2,000 units times $4 each, 8,000. We purchased 6,000 units at $4.40 each, 26,400. And then we purchased 2,000 units at $4.75 each, 9,500. Cost of goods available for sale. So our beginning inventory plus our purchases gives us cost of goods available for sale. So that's our 43,900, right? And that's our beginning inventory plus purchases, each equals cost of goods available for sale. And then remember, this cost of goods available for sale, then we should be able to subtract ending inventory to get cost of goods sold, would kind of be the next step. And this number will be different depending on whether we are doing FIFO, LIFO, or the weighted average cost method. So specific identification, like I said, this is where, the cost of goods sold represents specific units or specific items sold Ending inventory represents specific units of ending inventory that we have. And like it shows here, specific identification is usually only used when, there's small or um, uh, low inventory turnover, right? When inventory handling is a relatively small number of transactions, right? It matches actual cost against actual revenue. Um, and again, not very practicable for a company that has a larger number of transactions or a large inventory turnover, right? All right, so here's our example of that, and let's see how many times I have to click here to get to it. Okay, so it says CalMart Inc.'s 6,000 units of inventory consist of 1,000 units from the March 2nd purchase, 3,000 units from the March 15th purchase, and 2,000 units from the March 30th purchase. Compute the amount of ending inventory and cost of goods sold. So it shows here that we've got units in ending inventory, our number of units, our total cost of ending inventory. So if we had a total cost of goods available for sale, 43,900, less our ending inventory would give us cost of goods sold, right? Again, we do this with each inventory method, so we'll continue to get practice with this calculation. All right, the average cost method, hopefully we remember with the average cost method, we're computing an average cost per unit, and then we assign that cost to every unit in inventory. So prices items in the inventory on the basis of an average cost of all similar goods available during a period. And so we take that, and I'll give this formula again and write it on the board, I'm sure several times, but basically we're taking total cost of goods available for sale divided by the total number of units available for sale. That's how we get that average cost. All right, so we see that example here. And so based on this data, if we had cost of goods available for sale, 43,900, divided by the total number of units available for sale, that gives us that weighted average cost per unit, right? And so then we're assigning that weighted average cost per unit to the units in ending inventory, right? So if we've got 6,000 units in ending inventory times the weighted average cost per unit, we're valuing, or our ending inventory will be listed on our balance sheet at 26,340. So if we've got cost of goods available for sale, 43,900 minus our ending inventory, that gives us cost of goods sold, 17,560. Again, we're calculating this ending inventory cost of goods sold with all the methods. So we're going to see this, with FIFO and LIFO as well too. All right, so FIFO, first in, first out. Goods to be purchased first are the first to be sold, right? So the older goods get sold first. The newer purchases or the newer goods are what end up in ending inventory. So the newer goods that are in ending inventory are the goods that have approximate the cost, more closely to the current cost, right? Approximates the physical flow of goods for most businesses. FIFO used most often. And, again, when we are looking at this, we're looking at calculating ending inventory and cost of goods sold. The reason why it says fails to match current cost against current revenues is because, the cost, because we're selling the older goods first, the cost could have been incurred in a different accounting period than when we finally sell the good, right? The revenue comes in. So, but first in, first out, usually that approximates the physical flow of goods for most company, because again, companies don't want to have real old goods on their shelves. They want to sell the older stuff first, right? Just, if you think about like your local grocery store, for example, when they load the milk into the cooler, they load it from the back. So essentially the milk that was put there first is the first to be sold, right? That's with a lot of, they kind of stock the shelves from the back so that the older boxes are being sold first, right? Or the older products are being sold first, right? All right, so here's our example of that. And let me just see how many times I've got to click through this thing. So March 2nd, again, we had those 2,000 units purchased at $4 each. That would have been a total of 8,000. March the 15th, 6,000 units at $4.40 each. That would have been 26,400. So at that point, once we made this purchase, we had 8,000 units available for sale, 2,000 at $4 each, 6,000 at $4.40 each. That's a total of 34,400, right? If we do the math on that. And then we sold on March 19th, we sold 2,000 units from the $4 per unit category, and then 2,000 units from the $4.40 category. So then we end up with, where's my clicker here at? So then we end up with 4,000 units in ending inventory at $4.40 each. Again, this should look familiar to you because we really just did this in cost or look familiar to some of you, right? Because we did get some practice with this in cost and managerial accounting as well. Okay. And so then on March 30th, we purchased another 2,000 units at $4.75, excuse me. So then we've got a total of 4,000 at $4.40 each and 2,000 units at $4.75 each. If we do the math on that, that total is 27,100. So again, this would be the balance on, of our ending inventory, the balance on our balance sheet, right? All right, LIFO, last in, first out. Again, with LIFO, last in, first out. The goods to be purchased most recently will be the first to be sold, right? So last in, first out. The goods purchased last are the first to be sold. So remember in the previous example in FIFO, we would have sold these 2,000 units first because they're the older goods. But with LIFO, last in, first out. So we're going to sell these first is what we're going to see. So again, we've got 2,000 units at $4 each. That would have been inventory balance of 8,000. We got 6,000 units at $4.40 each. That would have been a total of 26,400. So if we add these two together, 2,000 at $4 each, 6,000 at $4.40 each, we've got a total of 34,400 inventory, right? Now we sell 4,000 units. Again, we're going to sell them from these 6,000. We're going to sell them from the newer goods, right? We're going to sell them from the newer goods purchased. So then we sell 4,000 units at $4.40 each. We're left with 2,000 at $4 and then 2,000 at $4.40. Again, we had 6,000 at $4.40, but we sold 4,000 of them, right? So we got 2,000 at $4.40 left. And now we make this purchase March the 30th, 2,000 at $4.75 each. So now we've got 2,000 units at $4 each, 2,000 units at $4.40 each, 2,000 at $4.75 each, right? So we're going to have total inventory cost 26,300 under LIFO. Again, that's what our inventory would be listed at on the balance sheet. So LIFO reserve, just like it's showing here, The LIFO reserve, some companies use this, many companies use LIFO for tax and external financial reporting purposes, but then FIFO, average cost or the standard cost system for internal reporting purposes. And so they talk about this on page 402 of your textbook, and some of these reasons that they list. So pricing decisions, companies often base their pricing decisions on FIFO, average cost, or standard cost assumption, rather than on the LIFO basis. The record keeping is easier. It says record keeping on some other basis is easier because the LIFO assumption usually does not approximate the physical flow of the product. Because again, with LIFO, we're selling the newer goods first instead of getting rid of the older goods. The third one, profit sharing or bonus arrangements. So profit sharing and other bonus arrangements often depend on a non-LIFO inventory assumption. And then the fourth reason, the use of a pure LIFO system is troublesome for interim periods, which require estimates of year-end quantities and prices. So, um, you know, one way that companies deal with this is by calculating basically an adjustment in inventory LIFO reserve, which is an adjustment in inventory. So the difference between the inventory method used for internal reporting purposes and LIFO is the LIFO reserve, right? It's calculated, they call that account the allowance to reduce inventory to LIFO. And so it's an adjustment between the inventory account if necessary. LIFO liquidation, it talks about the disadvantages kind of to LIFO liquidation in the book. And in as much as because with LIFO, we can have some of those older goods in ending inventory that did not cost us as much. But then when we eventually liquidate or sell these goods, we're selling them at current prices. So if prices have gone up, it's going to basically inflate our income because we're selling these goods at current price levels that may have increased. However, the goods are old, or older rather, and they were cheaper when they were purchased at a prior accounting period, right? So that's what it's talking about here. Older, low cost inventory is sold, resulting in a lower cost of goods sold, higher net income, and higher taxes. So a couple ways that this can be dealt with is by the specific goods approach. And then your book also talks about calculating the dollar value LIFO approach. So we'll look at both of those. Dollar value LIFO, again, we have a couple exercises picked out where we're going to get practice with this. And it does show us examples of this in your textbook, of course, but the dollar value LIFO method determines and measures any increases and decreases in a pool of products in terms of total dollar value, as opposed to the physical quantity of goods in the inventory pool. So what companies have to do, and there's kind of two advantages, and I know it talks about this here, but the first advantage is the broader range of goods in the pool. So companies may include a broader range of goods in a dollar value LIFO pool. And then also being able to do it this way permits replacement of goods that are similar items, similar in use or interchangeable, as opposed to being more, having to have, an exact similar unit for replacement in the pool. So this helps to protect the LIFO layers from the liquidation or the erosion that they talk about. All right, so what we do with the dollar value LIFO method is basically we're kind of doing a type of vertical analysis, really. We're looking at base year compared to the current year. So in this case, we're starting with 2014 as our base year. So then we're going to continually compare each year to the base year to compute the price index, right? And so that's what they're showing us here is, if we take, for example, well, 2014 is our base year. And so that's where we were starting 100% price index, right? So if we had inventory at the end of the year that cost us 200,000, that's also the base price, right? Since it's year one. Now 2015 prices have increased a little bit. So inventory at end of year prices would be worth 299,000 versus what the end of year inventory would be considering the base price. And so then it would only be 260,000 at the base price. That gives us that price index of 115%. In 2016, again, inventory at end of year prices, 300,000 compared to what that inventory would be at the base year prices. So that gives us a price index of 120%. 2017 inventory at year end prices 351,000 compared to inventory cost at base year prices 130% price index. So we can use that to determine what we need to adjust the account for. And so I'm going to click through this. I don't know how many times I've got to click it. Lord have mercy. Okay, and I know, we're going to do one where we get practice doing this together. But again, it's just showing us here, how we compute that LIFO reserve, basically, right? So according to that price index, and then, what adjustments need to be made to the balance sheet. Inventory, that allowance to reduce inventory to LIFO. Again, a contra asset account to the inventory account on the balance sheet. And so this one, 2014, again, that's our base year. So we have the index of 1 or 100%, right? Now 2015, we have index of 115%. And then the next year it goes up to 120%. And then the next year it goes up to 132%, right? So just looking at, reducing the cost of that inventory down to base year cost, right? Is what it's looking at. And the journal entry that we use and this is kind of an account that continually gets adjusted, just like we could kind of think about this like the allowance for doubtful accounts, how we adjust that account each year depending on what we want the balance to be. And that's the same thing that we're looking at down here. We adjust that allowance account for what we want the balance to be at that point. So it's a debit to cost of goods sold, credit to the allowance to reduce inventory to LIFO. Again, that allowance to reduce inventory to LIFO, we get that from that calculating that LIFO reserve. So, like I said, we've got a couple exercises where we'll get practice doing this together as well. All right, we can also calculate this price index depending on, and just like it's showing here, many companies that use this use the general price level index that the federal government publishes. So consumer price index for urban consumers. But we could compute our own specific price index by just looking at ending inventory for the period at current cost divided by ending inventory for the period at the base year cost. And that gives us that price index. And that's what we looked at on the previous slide. All right, so comparing those cost flow assumption methods, the average cost method, FIFO, LIFO. As I mentioned earlier, the average cost method kind of falls in the middle of FIFO and LIFO. And so you see that here. FIFO cost of goods sold would be 16, LIFO would be 20. Average cost falls in the middle. And then same thing with ending inventory, right? Ending inventory, depending on the method, again, average cost kind of falls in the middle, right? All right, these are some of the exercises that I have picked out for chapter 8, and we will get started on these on Monday. And I look forward, let me stop sharing this screen. Hi there. I look forward to going over those exercises with you on Monday. And, I do feel good about doing FIFO, LIFO, average cost method, because I know we have already been talking about that a little bit. So, and I do like doing those inventory methods and calculating ending inventory and cost of goods sold. So we'll have some fun with it this week. All right, guys. Bye-bye. Have a good weekend, and I'll see you guys next week.